Well, here we are again for session number 4, and we are going to be talking today about depreciation and the tax benefits that come along from owning a rental property. And I know taxes, it's like, yeah, why do we want to talk about this silly subject? But I think depreciation is probably one of the more exciting things about owning a rental property. Of any of the investment vehicles that I could choose to invest in, real estate gives me one of the benefits is depreciation, and you don't get that in the stock market or many other investment categories. So we're going to dig into it deep, and just to tease you, as owners of real property management franchises, there's a pretty special tax break for us that the general public doesn't get. So just to tease you with that, pay attention because you're going to want to hear this topic. So we want to talk about free money. How do we maximize depreciation? Because there's money out there that we get to use at no cost to us to maximize our wealth. Whenever I'm giving a seminar to the public, we always want to start with that disclaimer. This seminar is not a substitute for legal or tax advice. Anyone contemplating the purchase of a real estate investment should seek the services of competent legal tax advisors. And why that's important to put in there is, first of all, I don't know the future. You don't know the future. I certainly don't know all the tax laws. They're complex. They're going to be different for every investor. They're going to be different for me compared to you. And so that's not the point. It's not to give everybody exactly what their tax bill is going to be. The point is really to raise the questions, to get people thinking about what could be. How can they structure their investments in such a way to maximize their wealth? And then find the tax professional, the legal advice that they need to go maximize their situation. Okay, so let's do a quick review. We talked about cash flow and principal reduction last time, and let's remember that when we paid 100% cash, we had less risk, more cash flow, but a smaller return. But when we paid 20% down, we had more risk, because there's always a chance that, if the market turns south, we lose a tenant or whatever, we still got to make that mortgage payment, and so we've got more responsibility on our plate. We get less cash flow, because of course we have to pay the bank, but we get a greater return. And depreciation is going to help add another level to that return. And we're going to show you how to do that. Another quick question I'll ask people when I'm teaching the seminar and just try to get them involved is when using other people's money, the return on equity, remember we talked about return on investment versus return on equity. Return on equity, does it increase or decrease over time? It decreases over time. And you remember why that was. Just a quick, I'll show you that here in a second. And because our equity position increases over time, our return decreases. So here's our equity position. Remember, that's that bottom number. We're paying off that loan. We're making payments to the bank. We're making principal payments. That loan value is going down. That means that our equity position is going up from $20,000 to $50,000 to $100,000. And as that bottom number increases, as the equity increases, the top number, our return, doesn't increase that fast. Yeah, it might go up a little bit, but it's not going to go up, drastically. And so what happens is our ratio gets smaller and smaller over time. And so then we have to figure out, what do we do about that? Do we have to re-leverage? Do we have to 1031 exchange into something else? Do we need to sell, put it into a different investment vehicle? Well, this is important, and we're going to see this toward the end, that depreciation also wears out over time. And so we have time starts to, as time increases, our returns and our leverage starts becoming weaker and weaker and weaker. And so we want to see that so that we can take appropriate actions to maximize our investment. So let's talk about depreciation. What is depreciation? Well, if we look at the textbook definition, it's defined as a reduction in the value of an asset with the passage of time, due in particular to wear and tear. Now, to kind of think about this, to set this up, we can think about different types of assets. Okay, you've got cash assets, real estate's an asset, a car is an asset. Now, these assets do wear out over time. Now, if you think about a couple other quick examples, if we use cash to buy fireworks or a hamburger, that's an expense. We basically light the fireworks, boom, it goes off in a big shower of glory. We eat the hamburger, it's gone, okay, it's expended. But when we use cash to buy a car, we're not expending the cash. We don't lose the cash. We just exchange the cash asset for a vehicle asset or a cash asset for a real estate asset. And so, give you a quick example on this. If I bought a car for $10,000. So I've got $10,000 in cash here, and I trade that $10,000 asset, cash asset, for a $10,000 vehicle asset. I haven't spent it. It hasn't gone up in a big cloud of smoke and sparks like a firecracker would. Now, say I turn around the next day and I take that vehicle and I trade it back to someone else and they give me $10,000 in cash. Well, nothing has been lost in the transaction, okay? I've just traded one type of asset, cash, for another type of asset, vehicle or real estate, what have you. Now what happens over time, this is where depreciation comes in. Depreciation converts an asset into an expense over time. So let's take the same car. 10,000 cash, trade for a 10,000 vehicle asset. 2 years later, I want to trade my vehicle asset and turn it back into cash. Well, when I go to sell it, they'll only give me $8,000 for it. Well, what happened to the $2,000 between the $10,000 and the $10,000 and the $8,000? That $2,000 is an expense. So we've converted $2,000 of the vehicle asset into an expense and then traded the vehicle asset back into cash. And that trading, that essentially depreciation, the converting of the asset into an expense is what we call depreciation. Okay? And it's not something that really is an actual thing. It's kind of a paper loss, if you will. And we only realize it when we actually go and sell the car. So in real estate, there's actually two different types of depreciation. One's called straight line, and one is called MACRS for short, but it stands for Modified Accelerated Cost Recovery System. And we're going to look at both types and show you the pros and the cons to both. So as we get into both types, you have different categories that a real estate investment can be divided into. So think of them as buckets. And these are the buckets that go into real estate. So land. Land, that first one, that doesn't depreciate, right? Land doesn't wear out. It doesn't lose value over time. There's a limited amount of land in the world. You're never going to get more. That's it. And so the IRS says, no, it doesn't wear out. Then we get to personal property, and we'll talk about what that is in a second, but essentially personal property wears out in 5 years. Doesn't matter that it really did, but you get to take it as if it did. So you get to write off the expense as if it actually wore out in 5 years. In personal property, what that is anything that, in a rental property, quite frankly, it's going to be carpet and appliances are the two big things that are personal property and rental property. Then land improvements, that you get to depreciate in 15 years. And this is going to be anything that doesn't need the building to do its job. We'll talk about that in a minute. And then the residential building depreciates in 27.5 years, and then the commercial building is in 39 years. We're not going to go into the differences. There's different classifications for what constitutes each. So we talked about this. Land doesn't wear out. Personal properties, appliances, and carpet. And the land improvements basically says this statement: I don't need the building in order to do my job. So if it can say that, it was probably a land improvement. So you think about this. This would be like a tree, lawn, irrigation, fences, sidewalk, driveway. All those type of things can be broken out and depreciated faster than if you just kept them in the building. So this is actually the chart of how much depreciation you can take in each year. And I know it's like, wow, this is complex, it's irritating. Why does the IRS do this? I don't know. Did they just throw darts and say year 1 you can take 20%, year 2 32%, year 3 19%? I don't know why they did this, but it's the IRS. So presumably there's a method to their madness. Not sure what it is. It's probably some politics behind it. But this is what's here. Now, you're like, why do I need to understand this? Why don't we just make a tool for this? Well, this is all built into the Wealth Optimizer tool. However, I think it's really important for us to understand what's behind it, what's inside the tool, why it works the way it does. It doesn't mean that we have to calculate all this every single time. That'd be tedious, and that's why the tool exists. But it's important for us to realize what's happening in the tool, and that way we can catch mistakes and also maximize our investments. So just quick, let's look at this. Essentially, you see that personal property wears out in 5 years, and then you get a little bit left over in year 6. But every year is pretty much different. Residential building, that first year it starts at 3.48, and then it's 3.64 all the way to the end until the last year it's a little bit funny. Land improvements, 5%, and then 9.5%, and then it's different pretty much every year after that. And we're going to use this to calculate a case study. So in this particular case study, we want to look at and calculate the depreciation value for the first 2 years an investor owns the building by using, one, the straight line method, and then we want to compare that against the Mackers method. Okay? And we're going to go through how to calculate both and why it makes such a difference and how we can use our knowledge of depreciation to maximize and use, quite frankly, the taxpayers' money. Because that's what this is we get to use the taxpayers' money for a period of time before we have to pay it back to the government. How much money would the investor leave behind by using the straight line method? Okay, so that's kind of the two questions we're looking at. So here's our parameters, and you can feel free to figure this out. We'll pause the recording and try to calculate this on your own. But essentially, we have a purchase price of $520,000. And then we have just arbitrarily divided, we're saying 15% of the value of the property is land, and 85% of it is the building. Okay, that'd be the straight line method. And we're saying that this particular taxpayer is at about a 28% tax bracket. Under the Mackers method, land is still 15% of the value. But then we're taking these next three buckets and splitting them into personal property 10%, building 65%, and land improvements 10%. Same taxpayer, 28% tax bracket. So go ahead, pause the recording here, and see if you can figure out what these two things would be. And we'll meet you on the other side and walk through them with you. Okay, so here we are back. Let's test your answers. So first we have to figure out how much was the building cost, the land cost, etc. So we have to do some multiplication here. So we start with that total building cost. Well, how did I come up with $442,000? Well, real simple, right? You end up with $520,000 was the purchase price, and we said the value of the building was 65%. So we do the multiplication, and we'll get $442,000 is the value of the building. Then, and I'm not going to multiply all this out for us, but I've done the math here. You take the cost, the value of the building, times from the Mackers tables, 3.48%. Essentially, what this means is, if you think of the building as a pie, the first year, the IRS says, hey, you can write off 3.48%, right? This is your first year depreciation. And then the next year, you'll take another piece of that and another piece of that until the entire pie is eaten up in 27.5 years. Is essentially what we're doing here. So in year two, we're taking, take another piece of the pie, and we're going to get 3.64%. So now we have to figure out what's the dollar value of this piece of pie. Well, we know that the whole value of the building was $442,000. So let's take that value of the building times how much of the pie we want to calculate. So 3.5% essentially of the pie. And the math on that becomes $15,382 in year one. And then the second year value, the $442,000 times second year value equals the $16,089. That's how much we get to depreciate in years 1 and 2. Now, every taxpayer is different, right? Some people might be at a 15% bracket, some may be at a 35 or 39% bracket, but in this case, our investor is at a 28% bracket. So how much cash does this depreciation save him? Well, take it times 28%, you end up with $43,007 and $45,005 in year 2. Add those two up and you end up with $8,800 taxes saved. That number is a cash number, okay? If he didn't have this depreciation, he would pay taxes on that number, right? He would pay this much in taxes. But in this case, he will not. So here we have the next step. So let's look at the Mackers method. This is where we're, instead of having 2 buckets, land and building, we're going to divide it into 4 buckets. This looks complicated. It's not. I'm going to walk you through it. We're not going to do all the math together, but here we go. So we know that the building was $520,000. 15% of $520,000, the land is worth $78,000. Personal property we said was 10%. Well, 10% of 520,000 is 52,000. That's simple math. Here's our 65%, and here's our 10% of land improvements is 52,000. Now we do the next step is we say, okay, of the 52,000, that's the personal property value in this property, we get to take 20% of that in the first year. Okay, so take the 52,000 times 20%. That means we get to take $10,400 in depreciation for the personal property value bucket in the first year. Again, doing the math across, we get to have 11,000 for the building and 2,600 for the land improvements. We add those up, and now in the first year, total depreciation in the first year is 24,762. Do the same thing for year 2. Pay attention as I flip the slide. This is all going to stay the same. This is going to change, okay? Pay attention to the 20% and the 5% and watch what happens. Year 2, it went from 20 to 32%. For personal property and for land improvements, it went from 5 to 9.5. Okay? Again, we do the multiplication across, add down, total depreciation for the year, 33,883. So let's compare the difference. Well, not quite yet. So here we take the depreciation of these 2 years times our 28% tax bracket from our investor, and we end up with $6,900 for year 1 tax saved, $9,400 year 2 tax saved. Add those together, and he saves $16,420 in taxes in those first 2 years. So let's compare. With the Mackers method, $16,400. Straight line, $8,800. That means that with our investor at 28% tax bracket, the difference by using the Mackers method netted him an additional $7,600. Just by knowing the tax law a little bit, just by telling his accountant, let's use the Mackers method versus straight line. That makes that big of a deal. If he's maybe has a bigger, higher income, he's at 35%, he saves even more in taxes. Okay? So this makes a pretty big difference in taxes. Now, one other thing I'd like to say before moving on, pay attention. We're recording this toward the end of 2018. Of course, we had the Trump tax plan or break or whatever you want to call it, the beginning of 2018. Some of this stuff is going to change. So for example, I think personal property, I think they're giving you, if you purchase the property in 2018, you get to take it all. So not just 20% in that first year, you get 100% of it. So look into those things. Again, this is not about getting everything right. It's about knowing the questions to ask. Knowing the questions to ask our accountants, and if our accountant doesn't know, get a different accountant. All right, there's some additional fun things here. Let's say we've been doing straight line depreciation on our property, and it's like, this is the first time I've ever heard about Mackers. It's like, wow, I'd love to have some additional cash on behalf of Uncle Sam or the taxpayer. Well, if the building's been in service for less than 3 years, we can amend those tax returns. Now, there's kind of a pro and a con to that. If we amend those tax returns, the IRS will send us a check for that $7,000 that we overpaid in taxes, quite frankly. That's a cash asset, or cash dividend, essentially. If the building's been in service for more than 3 years, we can file Form 3115, which is an application for a change of accounting method. If we do that, we can go all the way back to the beginning of when we owned the building and push that forward. Now, the con to doing this is that's going to cost some money, right? You're going to have to pay an accountant to do that. If this is a small property, you could spend more with the accountant to make the change than you actually get in tax benefits. Also, if this property's been in service for like 15 years, it's probably not going to matter, because at the end of the day, the depreciation amount is the same, right? You're not going to get more depreciation using Mackers. You just get it sooner. And the sooner you get it, the more money you have up front, which means you can invest it, and money makes money. Okay, that's what we're trying to do, is how can I finance my properties up front and help my money work harder for me rather than me work harder for the money. The other benefit to knowing some of this stuff is that you can get into conversations with higher level investors. When, the building we're standing in right now, right, is a $40 million apartment complex. And I think it was just last week we had the conversation how they had talked about doing the cost segregation study on this building. And it costs, a decent amount of money to have this done. And they're measuring every different aspect of the building and trying to find where can they put all these different pieces so they can maximize their depreciation. And I think we calculated it out. The difference it was going to make this year to the investor, $400,000 cash. Just the depreciation on this building alone, $400,000 to the investor. That's a big difference, okay? And if we know this stuff, we're in those conversations, we get it, we understand it, we can help them make good decisions going forward. So that's called a cost segregation or a cost recovery study. That's what's going to happen on a large building. However, on small properties, we can still do this without spending a whole ton of money to commission this cost recovery study. And I'll show you how to do that. So you can do this on a single family, a duplex, whatever. But we need to have a reasonable explanation for why we're putting stuff in these buckets and claiming additional depreciation. Okay, so here's how to do it in about 5 minutes. Okay, so on a single family home, you just bought the property and it's like, yeah, I want to use this Mackers method. I want to maximize my depreciation. How do I do it without spending a lot of time and money? Here's how. The first thing we want to do is we want to calculate the ratio between the land and the building. And there's a really quick way to do this because the county tax assessor has already put their opinion as to what the building and the land are worth. So if we just go to the county records, this is a particular property. In this case, the county assessor assessed the value at $82,000. And they said the land is $13,000 and the building is $69,000. Well, with a little bit of math, I can take the land, which I'm just going to round up just for simplicity, $13,000, and divide it by the total value of $82,000, and that's going to give me 16%. So 16% of this property is land. A little bit more simple math tells me that 84% of the property is building, and that's based upon what the county assessor thinks. So I can kind of take his word for it, and obviously maybe if I wanted to get aggressive, I could get my own assessment done, but for the cost of that, this is good enough, right? We're not going to save enough money to make that worth it. Now the next thing we have to do is we have to go figure out what my property is actually worth. So I just bought this property for $115,000, which is different than what the tax assessor said it was. And that makes sense because oftentimes the tax assessments are 2-3 years behind what the actual valuation is. So in this, to kind of show you what this looks like, if I said, this is the value of the land, right? I'll just call that LD, land, and this is building. If that's $82,000 worth, I just purchased it for $115,000 worth. So essentially, the ratio stays the same, right? This still is 16% of the overall, and this is 84% overall. So what I need to do is just take 16% times my 115,000. So take my 115 times 16% will give me what my land is worth since I bought the property. And then I can do the next step for the building. But essentially, I figured out my ratios, right? Just because my value is bigger than what the county tax assessor says it is, I can still use my ratios, land to building, to figure out how much of it is land. Now we got to go to the next step. So first of all, I want to pay attention here. The building we're saying is $96,600. But I want to go the Mackers method, right? This would be sufficient to figure out straight line depreciation. If that's all I want to do, I'm good, right? And we can stop there. But if we want to go to Mackers, we still have to figure out land improvements and personal property. So let's do that next. Personal property is actually quite easy. If it's appliances and carpet, here's how I figured that out. This particular property is a duplex. And so I'm looking and I'm saying, okay, they have fridge, dishwasher, stove, dryer, washer. 5 appliances. It's a duplex. There's 10 appliances total. And what do appliances cost? Replacement cost? Well, about $500 on average. So 500 times 10 appliances, there's $5,000. Okay? $5,000 in appliances. The next thing we'll do is say, how much carpet's in place? Well, what's the square footage? We'll just take the square footage and say it times 2/3. right? Just kind of estimate about what you think is carpet versus vinyl or tile. If you say about 2/3 in carpet, you can figure out square footage times 2/3. There's your square foot for carpet. What's the value of carpet per square foot? And you can come up very quickly with what's the replacement value of the carpet. So we're saying $6,000 in this case. Add those two together and we get $11,000 in personal property value. So there's our personal property bucket. The next one, this one's a little bit harder because generally, you know, I don't have the cost of driveways and sidewalks and landscape and irrigation and fence right at the top of my head. I might have to go call a few people and find out. The other thing that you can do is some accountants will actually have the software and they'll know exactly what every square foot of driveway, lawn is worth. And then they've also got tools, of course, like, you know, Google Earth, look down on top of it and they can just map out, okay, got this much driveway, this much lawn, and this many trees, this much line of fence, and very quickly they can punch out for a few bucks how much your land improvements are worth. So if you can kind of put together a simple estimate, document why you did it, and we have our land improvements. Okay, the next step we have to do is remember we started with $115,000 purchase price. We figured out that the land was 16%, so we know the value of the land at $18,000. We said the building was the rest of it at $96,000, but we want to take this $96,000 and divide it into 3 buckets: personal property, land improvements, and building. And essentially how we do that step is we take the personal property, $11,000, and divide that by the entire value of the property, not just the building, the entire property. So now we know if we do the math on that, this becomes about 10% of the value of the property. So personal property becomes 10% of the value. We do 18,000 divided by 115,000, we'll get land improvements of 16%, which if we take 96 minus 11 minus 18, we will get $67,000 as the value of the building. And if we want, we can also figure out that that's now 58% of the value. So you can see what we did is we took that building that used to be 84% of the value and we pulled out some additional pieces so that we could depreciate these faster. Remember, we can get this one done, I believe, with the current tax law, we can take this all this year. Otherwise, it's over 5 years, and land improvements is going to take us 15 years versus spending almost twice that long if we leave it all in the building bucket. Okay, so that's how a real simple way to calculate this on a single family home. One other way I'll mention before moving on is if you can, when you buy the property, if you have the foresight for this, agree with the seller what they're selling you. So if you're like, Mr. Seller, I'd like you to sign this addendum. I want, you know, the building is worth this, the land improvements is worth this, personal property is this, and the land is this. This is what I bought, right? If you get audited by the IRS, Mr. IRS, here's what I purchased based upon the purchase agreement. That's another way to do it. Okay, moving on. IRS Publication 925. Real property management franchise owners. You have to read this. Okay, it's a little bit long, but definitely go through and read it because it gives you and I some amazing tax benefits. Okay, what it essentially says is the general public can't use passive losses to offset the earned income from their job. Okay, so this is what that looks like. Earned income is the money that you earn from payroll, salary, commissions, all that kind of stuff. It's going to be the money that comes in from your management company. So if I go like this, this is our earned income. And then over here, I think they also talk about portfolio income. And down here, you have passive loss. Passive income. What the IRS says, listen, if you lose money on your rental property, you cannot pass those losses and offset your earned income. So what happens when we do use MACRs and when we leverage the property using other people's money, we will have, certainly in the first years, we will have excess loss. We will show, even if we put money in our checking account, we're going to show the IRS, hey, Mr. IRS, I lost $1, $2, $5, $10,000 this year, right? That's what our tax return is going to show on this rental property. The problem is I can't use those passive losses to offset my earned income. Now, I could, if I had passive income somewhere else from a different property, perhaps use that, but the IRS doesn't allow us to do that. Except if I'm a real estate professional. If I am a real estate professional, we can use passive losses from real estate to offset earned income from our job. So when we're a real estate, suddenly the door opens. If I'm a real estate professional, now the passive loss can come in and offset that earned income and lower my tax bill, even though I'm making money from my job. I'll give you a real quick example here. Back in 2015, my accountant called me and said, hey, Josh, you've got an $8,500 income tax bill. I just did your taxes, and this is what is due. Well, okay, that stinks. I clearly underestimated what I was supposed to pay. But I said, hey, does it matter that I'm a real estate professional? And she's like, yeah, it does actually. She gets back on her computer and checks a few boxes, and lo and behold, now I'm getting a $2,500 refund check. Well, this is cash money. This is $11,000 cash money difference from going from having to write a check from my checking account, no longer can go on vacation, to the IRS, to now getting a $2,500 refund check. I've got plane tickets to Disney World. Okay, so that's the difference of just being a real estate professional, real life in 2015 for my family. So what does it take to be a real estate professional? Well, let's look at the rules. So this is all going to be in that Form 925. You have to have spent more than half of your personal services had to be in the real estate profession. That's one. And two, you have to have performed more than 750 hours of service in the real property trades or businesses in which you materially participated. So let's talk about some examples. Let's say you spent 20 hours of the year selling some real estate or managing some property, and you spent 2,000 hours of the year driving truck. Well, that's not going to fulfill number one. You didn't spend half of your time in the real estate profession. Number two, let's give you a different example. Let's say I spent 20 hours selling real estate and 20 hours driving truck, and the rest of the time I goofed off. Well, I didn't spend the 750 hours, the requisite hours, in real estate. So if you do the math, you can kind of tell that the IRS basically expects you to work at least 1,500 hours during the year, right? We know a full year or full-time working 100% of the time is about 2,080 hours. So they're expecting you to work at something for about 3/4 of the year, half of which has to be in real estate that you materially participated. So what sorts of things can you do to qualify? Well, here's the list. You have to develop or redevelop real estate, construct or reconstruct it, acquire it, convert it, rent or lease it, right? That's what we do. Operate or manage it, well, that's what we do, or broker it. So as long as we're doing these activities during that time, that would qualify us as a real estate professional. And if we qualify as a real estate professional, we can use the passive losses generated by our real estate to come up and eat up the money that we made in our real property management business. And so whether I'm a realtor, a property manager, or any of that list, man, it makes a whole lot of sense to buy real estate because that $11,000, right, that's a nice down payment on the next property. And so I can leverage essentially the taxpayers' money, the bank's money, to fast track my investment goals. All right, the next thing I want to talk about is, let me jump back. Before I get into this, there's one other thing that's in Form 925. I didn't put that on here. But you should know there are some ways that you don't have to be a real estate professional in order to actually, instead of having the real estate be a passive income or passive loss, you can actually get it to move up into this area by actively managing it. So maybe I'm an investor and I'm actively involved in it, and there's some additional rules and hoops you have to jump through, but it is possible to not qualify that real estate as a passive income or passive loss, but actually get it moved up here. So then when it's qualifying as earned or active income, then it can offset my active losses from the real estate, can offset my active income for my job. So again, it's detailed and definitely want to read it and talk to your accountant about it. The next thing is, if I'm married filing jointly, my spouse's earned income can also be offset by the real estate losses. Well, this is pretty cool. I think it might have been 1994 when this law changed. It used to be that anyone, doctor, attorney, high high earned income individuals were able to use all the losses from their real estate to offset their high salaries. Well, Congress put a stop to that except for those of us in the real estate profession. But if our spouse is a realtor, or if we're a realtor and our spouse is a doctor, the passive losses that I generate can offset her earned income. This is a great thing if you're married to a doctor or someone else that's earning a lot of income. Make sure you pay attention and use that. All right, let's talk about death and depreciation. Death, not a terribly popular topic. We're talking about death and taxes right now. But essentially, passing real estate as an inheritance resets the basis to its current value. And let me show you how that works. So here's an example. Let's say we purchased a house, or let's say Grandpa or Dad purchased a house for $100,000, and in 30 years it appreciated to $190,000. So it's worth $190,000. He's deciding, hey, I'm not long for this world. I got to figure out what am I going to do with this house. Do I sell it, give the money to my kids? Do I just donate the house to them? What do I do? Well, in 27 years, in a half years, it's 100% worthless according to the IRS, right? No matter which method we use, MACRS or straight line, it's depreciated out. We've taken all the tax benefits out of it. If we sold it the day before we died, or our dad died, we would pay recapture and capital gains tax on the $190,000. Now, it's a little bit complex on how that happens, but essentially, we're going to pay tax in order to cash out. And if we pass the cash off to the next generation, it's going to be worth probably about 30 to 40% less than the $190,000. Or, what if we kept it and we gave it to the heir as a house instead of as cash? If our heir sells it a day after our death, the IRS will value it at $190,000. That sold for $190,000. So essentially the basis adjusts from zero, right, it was completely depreciated out, back to what the current market value is, $190,000. And because there's no capital gain, right, 190 or 190, the heir pays no capital gains tax. So the person that passed away doesn't pay tax, and the heir doesn't pay tax. So the heir has two options. One, they could sell the property for $190,000 and pay no tax on it. Or two, hold that property as a rental, depreciate it out, $190,000, and get all the tax benefits for themselves on the second go-round. So definitely, if you've got real estate in your family, you want to be talking to a tax professional about how to dispose of that properly, because it makes a fairly big difference. Okay, there is a negative, right? If anything sounds too good to be true, there's always something we got to be thinking about that could kick us in the teeth, right? We saw that teeter-totter. Leverage is great, but it always has a downside. So let's talk about the downside. And that is capital gains or recapture tax. So how does recapture tax work? Well, recapture tax taxes the depreciation amount taken at your now current tax rate. That could be higher or lower than when you depreciated it. So for example, let's say we bought this property at $100,000 and we're at a 28% tax bracket. And so let's say it was really easy and we're always at a 28% tax bracket. And we had that house for 27 and a half years. Over that period of time, we're going to save essentially $28,000 in tax. Okay, real simple math. Doesn't matter which MACRS straight line we use, it doesn't matter. When we go to sell that property, okay, and let's say we made no money on it. Let's say it didn't appreciate at all. We're going to have to pay to that tax at that point. So the tax we saved, we don't get away with that scot-free. We just got to use the money for a period of time. And now we're going to have to pay it at some point in time. Well, here's what happens. We pay the tax at the current tax bracket that we're in. That could be higher than 28%. It could be lower than 28%. But it's at the point at which, when we sell the property. And so maybe if we know our tax bracket's high this year, we don't want to sell that property this year. We want to sell it next year when we think our tax bracket's going to be lower. But for argument's sake, let's say we sold that property for $100,000 at a 15% tax bracket. That means the maximum amount of tax we're going to pay is $15,000. Okay? And so here you see that we saved 28, we paid 15. That's a net savings to us of about $13,000. Now, it could go the opposite way, right? We could maybe sell this property and we're in a 35% tax bracket. Different story. We saved 28 and ended up paying $35,000. Now we have it almost hurt us. with the exception that we got to use that $28,000 all this time and build wealth from it, so we'll be okay. But just be aware that when we sell the property, depreciation isn't free. The next thing we have to worry about after recapture is the capital gains piece. So capital gains is, the 2018 capital gains rate is 15%, and I think it goes up to 20% once you earn over like 400 and some thousand dollars. But it's only taxed on the gain. So if the purchase was $100,000 and we sold it for $150,000, the capital gains is only taxed on that $50,000 gain from what we bought it for to what we sold it for. And that's always going to be at that 15% rate or 20% if we're a really high income earner. So the recapture could actually be higher than the capital gains. So let's say I'm at a 28% tax bracket. I could pay recapture tax at 28% and then pay the capital gains at 15% for the rest of it. Or maybe I don't want to sell the property. Maybe I just want to do a 1031 exchange. Maybe I want to sell this one and exchange it into another one. I believe I just read that the 2018 tax law shut down 1031 exchanges for some asset classes, but not for real estate. Still can do it with real estate. Here's what this looks like. So there's a couple caveats with this. There's some really good websites out there that will actually, you can put in all your information. It will basically break down exactly what you're going to pay in recapture, capital gains, what you're going to save by doing a 1031 exchange. So you know before you ever get into it what your tax burden is going to look like. So here's how I want to break this down. So if we bought this property again for $100,000, the maximum amount we could save is 28%. At a 28% tax bracket is $28,000. Let's say we sell that property for $100,000 and we buy the next one for $500,000. We don't get to take depreciation on $500,000, okay? Because of the exchange, we only get to take depreciation on the difference between the new property and the old property, or the difference in the depreciation that we didn't take. And because we took all the depreciation on this property, listen, there's only $400,000. We don't get to double dip on this. So we only get depreciation of $400,000, which means that the max tax saved on the new property, $112,000. So what's the effect on the return on equity for depreciation? Well, depreciation is a cash benefit, right? It means that I either don't have to pay the IRS money or they're going to give me a refund. So that's a cash benefit. It reduces the cash I pay to the IRS. So it increases the cash flow during the years it is claimed, but it negatively affects my cash out after the sale because of that recapture capital gains issue. This is just a quick example of what it looks like over time. So depreciation, right, this is a Macker's method, that year 2 is actually a better year than year 1. Goes up and then it kind of bleeds out over time. Here's year 15, 16, 17, year 27, 28, and then year 29, it's completely depreciated. No tax benefits after that. So when we think about return on equity, remember, as we go, our returns are getting less. Our equity is increasing, but our returns are bleeding away. Well, depreciation is also wearing out, getting weaker over time. Here's another reason why in 5, 10 years, we want to start looking and saying, listen, do I need to exchange this into something better? Think about it for our clients. Should we be having these conversations in 10 years? They've owned the property for 10 years. Hey, let's look at this. Maybe you could do better with something else. Can we sell this property, re-leverage into something larger, something newer, something better, something with less headaches and maintenance? Those are great conversations to have, really good value-add conversations to have. Also, as a realtor, if I was a realtor, do you think this might be good, something good to know, right? If I can come to my client and tell them, hey, listen, let's refresh that depreciation. Let's get you into something that's got more depreciation. We can re-leverage your money, right? This is being an advocate for our client. Another just quick example on the return on equity. Here's our previous example, right? Our equity is increasing and our returns are decreasing. Essentially, with depreciation, it's just going to increase those returns, and quite frankly, it's going to kind of bleed out over time, but same thing's going to happen. Things are going to get weaker the longer we go. All right, the last thing we're going to do is do a case study. Let's break this down top to bottom. I'm going to have you go through and calculate MACRs for a large property. So first thing we want to do is we want to calculate the depreciation for the last 2 years of operation using MACRs. Then we want to calculate the tax or cash saved for a 28% tax bracket, a 33% tax bracket, and then a 39.6% tax bracket. And I think these are actually 2017 brackets. I think 18, there's different brackets. So we can update this if you like. Essentially, the math is the same. So go ahead and we'll look at the statistics here, and then you can shut off the recording, figure it out yourself, and we'll come back and review it. Purchase price is $1 million, which makes all the calculations super simple. The land is 10% or $100,000. Personal property, 10%, $100,000. Land improvements, 15% or $150,000. And then the building is left at 65% or $650,000. So use that information and go ahead and calculate this case study. Okay, so here we are. Real simple math. These are just the answers. We know that personal property was $100,000, and we've gotten the 20%. We get to use 20% of the value of the personal property in year one and 32% in year two, right? And we took this from the Mackers table that we saw on a previous slide, and that will be part of the additional items. Also, keep in mind that this stuff is all built into the Wealth Optimizer calculator. So you won't have to do this manually, but at least you know how it's being done. So here we have 100,000 times 20,000. 100,000 times 20% is 20,000. Year two is 32,000 for a total of 52,000 in personal property. Land improvements, we take the 150,000 times 5% gives us 7,500. Again, 150,000 times 9.5%, which gives us 14,250. Add those together, we get 21,750 for land improvements. Building, same thing, 650,000 times year one gives us 22,000 that we can depreciate. 650,000 times 3.64% in year two means we get to take $23,660 in year two. Add those two together, we get to write off $46,280. So here's what it looks like. Here's our depreciation for 2 years in the three categories. Add those together, we get to write off $120,000 in the first 2 years. So that's the first answer. How much do we get to write off? Now let's look at the different tax brackets. We don't get to obviously take, the cash value is not $120,000. It depends on what our investor's tax bracket is. So in a 28% tax bracket, simple math, essentially $120,000 times 28%, $33,000 in cash saved. Didn't have to pay it to the IRS, or the IRS is cutting us a check back. At the 33% bracket, you're at $39,000 saved. And at the highest bracket, you're at $47,000 tax saved. This is just an extra. If we think about return on equity in the first 2 years, because this has increased our cash flow, right? You can kind of think about it as an extra return. Now I know we may have to pay it back unless we pass away and pass it on to our kids. But if we don't have to pay it back, essentially it increases our return. If with a 25% down, right, $250,000 on a $1 million property, it increases our return nearly 7%, 8% or 9.5% a year, depending upon where my tax bracket is. That's cash money that I can now use to go out and invest in other property and build my capital and wealth. So this one I threw in here just as it's pretty cool to see, because oftentimes this is what we're trying to get at with Wealth Optimizer. So often, what's the one thing that people look at? They look at the cash flow. That's all they see. It's the monthly number that they get, right? And when there's a toilet flapper that broke and that we had to fix, man, what in the world? You're stealing from me, man. I'm losing money, right? Well, here's what we want to show them, that there are other things at play here. So let's take our example. We invested $250,000 in this case study, 25% down. The taxes we determined had a 28% tax bracket, saved us $49,000. That's cash money, okay? Cash money in our pocket that's spendable. Then if we had just a mere 3.5% appreciation for those 3 years, that's another $110,000. Now, we wouldn't get this till we sell, but it's there. Now we have principal reduction, right? The tenant is essentially, the rent is paying off our loan. If we had a 30-year loan at 5.75% interest, that's another $30,000 in equity that is now ours in building our wealth. And then we had a cash flow of $57,000 in this particular example. Our total benefit in 3 years is why I pulled 3 years, $247,000. Well, notice, $247,000, what did we invest? We invested $250,000. In 3 years, we've generated basically $250,000 in value from this asset. Now, the problem is, of course, we can't take it. We can't spend it. Or could we? Right? What happens in 3 years? Can we spend the tax savings? Absolutely. That's spendable. That's cash money. Can we spend the cash flow? Sure. That's cash. So the only two we can't spend are these two, the appreciation and the principal reduction. But what if we refinance the property? What if we got a new survey? What if we got a new appraisal on it? Could we refinance it, pull the appreciation out, pull the principal reduction, the equity that we've built? Sure we could, right? So essentially, we've got two pieces of cash already, and with a little bit of work and a little bit of extra money, we could actually cash in these two and pull out $247,000 in 3 years, right? We could have our initial investment back in 3 years in this example. So like I said, most investors only see the cash flow benefit. That's all they think about, right? And when that cash flow is zero, when it's slightly negative, man, the world's coming to an end, right? That's the conversation we're having on the phone. Where's my money? Why did you spend my money? Why did my tenant leave, right? But there's this other conversation we need to be having. So this is just a 1 year on this example, $19,000 on this particular example, and a 7.7% return. Okay, so what? 7.7 return, I'm not getting too excited about that. But here are the things we don't see, right? We don't see the tax saved. There's no line item on our tax return that says, hey, your property at 123 Anywhere Street just saved you $16,000 this year that you get to spend, right? There's no line item like that. Appreciation, where's the line item on that? How do we ever find out what our property has increased in value? Well, we don't know, right? Our investors don't know, except Wealth Optimizer, the tool has that built in, so we can start making some assumptions. That's going to be the next class. We're going to talk about appreciation and inflation and how that works together and how we calculate it, so we can kind of start to forecast and say, okay, I've had this property for 3 years. I bought it here. What's it worth today? Okay? But there's nothing out there that's going to tell them what it is. How about principal reduction? Where does that show up? Well, if I'm smart, I might be able to figure it out from my loan statement. I have to do some math on it. It might be, they might send it to me at the end of the year, but I don't know on a day-to-day basis what my principal reduction is. Wealth Optimizer tool will tell me that. And finally, cash flow, of course, we're getting that from our normal property management statements. But at the end of the day, this is what educated investors see. They don't just see the $19,000. They see the $82,000. And that's what Wealth Optimizer is designed to do, is to pull the curtain back and expose all the wonderful benefits that are happening behind the scenes in this rental property. Now, look at what our average return on investment is in 1 year, 33%. Okay? That's worth getting up out of bed in the morning. That's worth owning rental property for, right? 7.7%, yeah, stick that in the stock market and get that pretty easily. But now we're talking, right? So there you have it. That's what I have for you. That's maximizing depreciation. That's free money built on the tax laws that we have at play. We'll see you next time for the appreciation seminar. Thank you.